My name is Terry Eckert. I'm a CPA, ABV, and CFF at Candy and Schonwald, PLLC. I'd like to welcome you to our webinar, Tax Planning Strategies. Joining me today is Annette Wiley, an enrolled agent here at Candy and Schonwald. This webinar will cover just a few selected tax strategies, and while it is important to note that not all tax strategies will apply, hopefully today's webinar will give you some ideas to think about and bring up in a discussion with your tax professional.
We'll start today with some pointers on choosing the right business structure. If you are starting a new business or are considering a change in your business structure, your choice of entity can be an important tax planning strategy. Different entity choices produce different taxation effects for your business. For example, if you will be the sole owner of your business, one choice available to you is to run your business as a sole proprietorship. With this type of business, you will pay income and Social Security taxes on the net income of the business. However, you can withdraw funds from the business without incurring additional taxes, so you avoid double taxation that occurs with a corporate business structure. Another option available to both single and multi-owner businesses is the corporation. The choice to be taxed as an S corporation can avoid double taxation, similar to a sole proprietorship. However, with an S corporation, you will need to pay yourself wages and handle payroll reporting, even if you're the only one working in your business. Alternatively, the choice of a C corporation provides very different results than an S corporation. A drawback to the C corporation is that it is subject to double taxation. This is because the net income of the business is taxed at the corporate level and then again at the personal level if and when you make distributions to the shareholders. However, a benefit of the C corporation is that the corporate tax rate allows more income at the lowest 15% bracket. This means that in certain cases, this entity choice may actually provide you a tax savings. If your business has multiple owners, you might also want to consider forming a partnership. This type of entity allows you to make special allocations and distributions that cannot be made to owners in a corporate structure. A partnership is also a good entity choice if the business will own appreciated properties such as land. This is because partnership taxation rules allow you to distribute the property out to the partners without creating taxable income at the entity level. An increasingly popular option is the limited liability company. This entity choice allows you to choose between the various taxing structures we've just discussed, and you also have the flexibility to change taxation with this structure if desired. If you're making the choice of entity type, it is essential that you consult with your tax professional. There are a number of factors to consider in addition to the basics we have just discussed. If you're in the business of providing professional services, there are some variations to the choices available. Your tax professional and your attorney can also help you understand other factors to consider, such as legal exposure and protection, possible regulations, state taxation, and filing requirements.
Business structure can also be an effective tax planning strategy for family assets. A family limited partnership, or FLP, is a limited partnership consisting of family members. Usually, it is created by parents for the ultimate benefit of their heirs. The parents' selected investments are transferred into a partnership in exchange for general and limited partnership interests. The general partnership interests allow for control of the underlying assets, while the limited interests include economic benefits. This transfer is usually tax-free because the parents are merely substituting ownership of specific assets for ownership of an entity that owns the assets with the same level of control. Once the assets are in the FLP, the parents may choose to give limited partnership interest to their children or other heirs. The FLP that is created should be operated as a business. The assets transferred to the FLP should not be relied upon to provide the support of those who created it, called the settlers. and the FLP should be respected as an entity separate from any partner. Not respecting this difference could subject the FLP to creditor or IRS scrutiny. A family limited partnership can be useful for many reasons. For many families, an FLP can provide creditor protection. If a partner in an FLP is sued, a creditor can take the debtor's interest in the FLP, but as a partner, the creditor cannot access the underlying assets of the FLP. If the FLP pays a cash distribution, the creditor has a right to its allocable share of the distribution. However, only the general partners are able to make management decisions, including whether and how much to distribute. Because of the limitations, holding an assignee interest in an FLP is generally unfavorable to creditors. An FLP can provide for centralized management for a portfolio of similar or dissimilar assets. Transferring ownership of a portfolio of assets into an FLP allows the FLP's general partner to manage the portfolio. Although the general partners of an FLP, usually the parents, continue to manage the assets according to their wishes, if the parents are no longer able or willing to manage the assets, they can direct future management decisions to an alternate manager. An FLP can provide continuity of life for a particular investment portfolio or an investment methodology. Although an FLP has a finite life, it can last decades if desired. While living, the parents can control the FLP. When both parents are deceased, control of the FLP can move to an alternate general partner in accordance with the parents' wishes, or the FLP can be dissolved and the assets distributed to the partners. An FLP can also provide potential gift and estate tax savings. Although transactions initiated solely for tax-motivated reasons will usually not qualify for any gift or estate tax savings, FLPs organized for other reasons can provide tax-saving benefits. When an FLP interest is gifted or inherited, a valuation is performed to ascertain the value of the interest. Since the limited partnership interests only contain an economic benefit and no control over management of the FLP or its assets, the fractional interests given are less valuable than the limited partner's pro rata share of the net assets. The transferred interests are usually discounted for lack of control and marketability, so the value subject to taxation is less than if the investments had been transferred person to person directly. We can help you decide if a family limited partnership fits your investment and estate goals. If you need, we can refer you to an attorney that is knowledgeable about FLPs for assistance in creating an FLP for you. Based on the objectives of the FLP, we can help you administer it so that its objectives are achieved. If you plan to make gifts during your lifetime, we can perform valuation services to ascertain a gift's value. We can also prepare the necessary federal gift tax returns that are required.
Continuing with family businesses. If you run a family-operated business, you may be able to deduct some of your child's college education as a business expense. If you have a family-run business and your child works for you, you might benefit from establishing an educational assistance plan as part of your fringe benefits package. You can reimburse your employees up to a specified amount per year for qualified educational expenses. The reimbursements become a deductible business expense for your business, and the reimbursements are not taxable income to your employee. For your child to qualify, they must be over 21, they must be a legitimate employee of the business, they must not be more than a 5% owner, and you cannot claim them as a dependent. To establish the plan, you must adopt a written plan that covers a broad cross-section of employees. However, the fact that most or all of your employees are your children does not disqualify the plan. If you're a sole proprietor, you may also be able to convert your medical expenses into business expenses. If your spouse works for you in your business and you have no other employees, You may be able to design a fringe benefits package that allows you to deduct medical costs as a business expense. Your spouse must be a bona fide employee of the business and provide substantial services to the business. You must pay wages and issue a W-2 to your spouse. Your spouse must not be a co-owner of the business. You must have a written plan document to establish employee medical expense reimbursements as part of your fringe benefits package. And you must offer this to all employees, so it is probably not a good option if you have additional employees. You should consult a professional because you will want to be careful that you meet all the requirements to support this strategy. However, if you qualify, you can provide health insurance as well as medical reimbursements to your employee spouse. Your employee spouse can then cover you as part of their family. The result is that you can convert the medical expenses for your family to legitimate business expenses, which are fully deductible instead of itemized deductions, which are subject to limitations.
Regardless of your business type or structure, you can always consider making capital investments to benefit your business and take advantage of temporary expensing options to reduce your current income. For tax years beginning in 2012, qualifying depreciable business assets placed in service during the year can be fully expensed under Code Section 179 up to a maximum of $125,000 or your taxable income, whichever is less, as long as the total investment in such property does not exceed $500,000. This means that some assets you would normally have to depreciate over several years may be fully expensed for 2012 to reduce your taxable income. Qualifying Section 179 property is generally new or used tangible personal property, such as equipment or furniture, which is purchased for use in the active conduct of a trade or business. It is important to note that real estate rental is not considered a trade or business for Section 179. Another expensing option available for property placed in service during 2012 is bonus depreciation. Property qualifying for this option can be expensed at 50% for 2012, and the remaining 50% can be depreciated over time. This expensing option is available without a taxable income limitation. Property qualifying for bonus depreciation for 2012 is generally new property with a recovery period of 20 years or less. This includes property such as equipment and furniture. Additionally, qualified leasehold improvement property placed in service during 2012 is also eligible for bonus depreciation expensing.
Another strategy that can be utilized by almost any business is a retirement plan. If you own your own business, there are a number of retirement plan options to consider. The first type is a defined benefit plan. These plans are designed to provide a specified benefit amount upon retirement. This is a fairly complex plan with a significant amount of cost. It is usually found in large companies. However, in limited situations, it may be beneficial to a very small business. If you're able and willing to contribute very large amounts of money to the plan each year, it can provide for large deductions against your taxable income. The second type of plan is a defined contribution plan. Contributions to these plans are determined as a percentage of compensation and are made to employee accounts held within the plan. One common defined contribution plan is the 401k. This is a qualified plan which will require testing and meeting specified standards, accounting for vesting and other features of the plan, and filing of Form 5500. The benefits of our 401k are that it allows employees to make contributions at a percentage of compensation up to a set limit. These may be either tax deferred or not, depending on whether the plan is a Roth or traditional 401k. Additionally, as an employer, you will make a tax-deductible contribution as a certain percentage of employee contributions. A second type of defined contribution plan is the profit-sharing plan. This is also a qualified plan with requirements similar to the 401k. However, it offers the employer more flexibility, as your contribution percentage can be determined annually. You can make a tax-deductible contribution for each eligible employee. And finally, there are IRAs. These are funded through individual employee accounts. A SEP is one type of IRA plan. A SEP has lower administrative costs and does not require the filing of Form 5500. Deductible employer contributions can be determined on an annual basis, which allows for flexibility similar to a profit-sharing plan. Employer contribution limits are the same as a profit-sharing plan as well. One drawback to this type of plan is that even minimal part-time and seasonal employees must be covered. However, you can implement it and make your contribution as late as the due date of your business return. Another type of employer-established IRA plan is the Simple IRA. The Simple IRA is easy to set up and does not require a Form 5500 filing. This plan allows employees to make contributions at a percentage of compensation up to a set limit, and as the employer, you must make a deductible matching contribution. The various plans have different requirements, costs, complexities, and results. If you have not set up a retirement plan for your business, you should seek professional advice in choosing the plan that is right for you. As an individual, a contribution to a retirement account offered by your employer can save you tax dollars. If it is a traditional type of plan, the contribution you make reduces the amount of income you are taxed on for the year and allows your investment to grow tax deferred. If it is a Roth plan, your contribution will not provide a current year reduction in taxable income, but your investment can grow tax-free, and qualifying distributions from the plan will be tax-free to you when you retire. Additionally, if your employer plan provides for some level of employer matching, your employer contributions can also grow tax-deferred. You can also consider contributing to your own IRA. If you contribute to a traditional IRA, you can reduce your taxable income as long as your adjusted gross income does not exceed specified limits. Alternatively, you can contribute to a Roth IRA. Roth contributions will not reduce current taxable income, but your qualifying distributions will be tax-free. Contributions to a Roth IRA may be limited based on your filing status and adjusted gross income, so you should check with your tax professional to determine your maximum contribution.
If you already have an existing IRA, you might want to consider converting your traditional IRA into a Roth IRA. Converting your existing retirement account to a Roth can be an effective long-term tax planning strategy if the circumstances are right. Converting to a Roth changes your account from a tax-deferred account to a tax-free account. To do this, you must pay taxes now on the amount you choose to convert. This means you increase your tax now but save taxes in the future. So why might it be a good strategy to pay taxes now instead of later? All future earnings on the converted funds will be tax-free. If you are currently in a lower tax bracket than you expect to be in at retirement, you can pay now at the lower rate. If you have a year with considerable ordinary losses to offset the converted amount, you may be able to make the conversion with minimal tax consequence. If you were previously unable to make a Roth contribution due to adjusted gross income limits, those limits no longer apply to conversions. This means that while you may be unable to make a direct contribution to a Roth IRA, you may still be able to maximize your traditional IRA deduction and then convert it to a Roth. However, remember that when you do a Roth conversion, you are creating a tax liability, so you need to plan ahead and be prepared to pay the tax created by the conversion.
Another pre-tax savings opportunity to consider is a health savings account. Health savings accounts, or HSAs, were created so individuals covered by high-deductible health plans could receive tax-preferred treatment of money saved for medical expenses. Generally, an adult who is covered by a high-deductible health plan and who has no other first-dollar coverage may establish an HSA. A taxpayer who is an individual eligible for an HSA on the first day of the last month of a tax year is treated as eligible during every month of that tax year, so the annual limit on deductible contributions for that taxpayer is not reduced. Contributions to HSAs are deductible in determining adjusted gross income, while withdrawals for qualified medical expenses are tax-free. Individuals who reach age 55 by the end of the tax year can increase their annual contributions by $1,000. Contributions cannot be made after the participant attains age 65, but withdrawals for qualified medical expenses continue to be excludable from gross income.
Thank you for attending our webinar. I'd like to remind you to consult a tax advisor before implementing these and other tax planning strategies to ensure you get the best results possible for your situation. Look for our next webinar coming out later this year on QuickBooks, common problems that impact your financial report. Also, refer to our Candy and Schonwald website at www.cscpa.com or email us with your questions. Our goal is to help clients secure a sound financial future. So if you or someone you know would like to know more about these ideas or the services we offer, please contact us.